Welcome to the Nichols Tax Update podcast. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You're receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I acknowledge the value of my subscription to Tax Notes Today, a publication by tax analysts, the preeminent source of information for tax professionals in the preparation of this program. So we have 5 items this week, down from our usual 8 or 9, but the first one is particularly interesting. What's here? An individual is granted innocent spouse relief from joint tax liability. It's a innocent spouse case, but it's a 23-page opinion. It goes through A to Z. It's a wonderful teaching case. We get one of these about once a year, and so about once a year, we're going to talk about innocent spouse relief in this series of programs. This opinion gives us a thorough review of the 7 threshold conditions, the 3 conditions for streamlined relief, and a non-exclusive list of facts and circumstances, considerations that are considered in granting equitable relief. It's a lot more complicated than it looks on the surface. We get final bonus depreciation rules, but final doesn't really mean final, if you know what I mean. Final regulations on the treatment of deductions allowed for estate and non-grantor trusts that are not considered miscellaneous itemized deductions. That'll be helpful. Not a lot of application, but it'll be helpful. The IRS reiterates that there are no 1099-Cs to be issued for debt forgiveness on the PPP loans. We'll talk a little bit more about it when we get there. And finally, the IRS reviews the home office deduction rules. What an exciting headline, but it turns out it was misleading. Let's begin by talking about the individual spouse relief, innocent spouse relief granted to Beverly Robinson in TC Memo 2020-134. Tax court held she was entitled to innocent spouse relief under Section 6015F, which is equitable relief from joint tax liability with her former husband. The liability was attributable to his lawn care business. After satisfying all 7 threshold conditions for granting relief, the court found she did not qualify for the streamlined relief, which had 3 conditions, so her last hope was for equitable relief, which imposed an additional set of 7 conditions, some of which were duplications of the original 7, along with a facts and circumstances test, which allowed for some judicial discretion. A good thing here, because the judge started out with the Judge Carolyn Chiecki and was transferred to another woman judge. The husband's testimony was not credible. The allegations against him were that he was not a nice man. He was unfaithful. He squandered his money, etc., etc. All the reasons for divorce, right? The next slide lists the conditions necessary for granting equitable relief listed in Revenue Procedure 2013-34. And if you do a lot of divorce work and a lot of work with separating couples, you need a copy of Revenue Procedure 2013-34, and you need to know exactly what it says. Let's follow along with the judge's analysis applying Revenue Procedure 2013-34, recitation of the factors for granting equitable relief after the spouse claiming innocent spouse relief has satisfied the 7 qualifiers and then not satisfied the requirements for expedited relief. So here we go. 3 factors for granting relief weigh in her favor. She's divorced, she did not have knowledge that he wouldn't pay, and she did not receive a significant benefit. That's 3 of 7. Economic hardship and mental or physical abuse are not alleged, so 3 of 7 are neutral. Finally, she had not filed her returns as a single taxpayer on time. So the timely tax compliance factor required for equitable relief was not met. 1 of 7 is negative. Let's see, 3 plus 1, that's 7. Mrs. Robinson, however, wins 3-4 to 1 against, the other 3 being neutral. So what I think you want to remember, we all want to remember here, is there are 3 numbered lists that are all recited and explained in Revenue Procedure 2013-34. 7, 3, and 7. The hoops that you have to jump through in order to get equitable relief under Section 6015F. Once again, for those of you that are watching this video that have any training responsibility for younger people in your tax function, this is an ideal training case to teach them about Internal Revenue Code Section 6015 and the available relief under 6015B, C, E, and/or F. Next, final depreciation regulations, 1 of 2. Now, if you believe final, then you'll believe anything. TD 9916, these regulations provide answers regarding the 5-year look-back for the used property exclusion, explaining that used property exclusion does not apply if the taxpayer used the property 6 or 7 years ago. More than 5 years ago, the used property exclusion doesn't count. It's only if I use the property within the last 5 calendar years that the property cannot qualify for bonus depreciation when I acquire it. It also, these final bonus depreciation regs also get into the election to separate larger self-constructed property into its component parts so that you can claim bonus depreciation in the appropriate year, and application of the rule to a series of related transactions. Many taxpayers, I think, will also want to consider filing amended returns based on the interpretations of the law in these regulations. The Treasury declined requests from automobile dealers to make the trade-off between the new bonus depreciation provision of 168K and the limitation on deductibility of interest under 163J voluntary. Here in 2 of 2, I want to explain that while several groups, such as real property businesses, can choose between full interest deductions and bonus depreciation, the floor plan financing trade-off of interest to automobile dealers isn't taxpayer specific, but applies to the interest itself, the floor plan interest itself, and it didn't explicitly get that choice treatment. You can't choose. Taxpayers with floor plan financing interest, however, did get some relief when the government declined to make the trade-off permanent, opting instead for annual testing, an important thing to remember for your automobile dealers who may be worrying with the availability of bonus depreciation and full deductibility of their interest. In any event, these are not the last final regulations on the subjects, plural, that are dealt with in 168K and 163J. Taxpayers are still going to need transition guidance on some issues. Final miscellaneous itemized deduction regulations. What an engaging headline, but on a very limited topic. These regulations clarify that some deductions allowed to an estate or a non-grantor trust are not considered miscellaneous itemized deductions and are not limited by Code Section 67G. Well, pray tell, what would those be? Those include costs paid or incurred in connection with the administration of an estate or non-grantor trust that would not have been incurred if the property had not been held in the estate or trust. The personal exemption of an estate or non-grantor trust, the distribution deduction for trusts distributing current income, and the distribution deduction for estates and trusts accumulating income. Well, those weren't the main problems I had with miscellaneous itemized deductions, but I appreciate the guidance. All guidance is valuable, right? Information reporting is not required on forgiven payroll protection plan loans. Announcement 2020-12 makes it clear that lenders do not need to file information returns or furnish payee statements under Section 6050P to report the amount of qualifying forgiveness regarding covered loans made under the Paycheck Protection Program. Under the CARES Act, any amount that would be includable in gross income of the eligible recipient by reason of the qualifying forgiveness is excluded from gross income. That's what the law says. So don't be looking for a 1099-C. Filing information returns would simply create confusion, and I don't know about you, but I have already observed confusion in my individual tax practice with banks filing 1099-Cs late, filing 1099-Cs when they knew that the debtor was insolvent because they had conducted an investigation of solvency before they made a decision to forgive the balance of a credit card debt or some similar obligation. So don't just automatically report income from a 1099-C. Question the circumstances. Was your taxpayer insolvent? On what day was your taxpayer insolvent? And on what day was the debt forgiven? Obviously, I get excited about these 1099-Cs that are floating around that have nothing to do with properly calculating my client's taxable income. All right, next topic. Could any of your clients claim a home office deduction? Wow, that headline got my attention, but probably not. Turns out this was nothing new. The item simply recited the general rule allowing self-employed taxpayers, independent contractors, and individuals working in the gig economy to file a Schedule C and a Form 8829 to claim the deduction. In fact, the IRS notice, the information release, contains this sentence: employees who receive a paycheck or a W-2 exclusively from an employer are not eligible. A lot of help. Big deal. Well, that's a wrap for this week. I apologize for getting carried away on a couple of those items, excited, but I do want to reiterate that first item on innocent spouse relief is an ideal teaching case. It has great facts. It requires you to analyze all 17, 7 plus 3 plus 7 of those factors. A great teaching case. Thank you for your attention. Thank you for participation. Until next week, remember, stay safe.